A lot of people have been looking at ticker symbol UPWK, Upwork, which is this online kind of freelancing marketplace platform where you can hire people or get solutions if you're an enterprise. And the share price is down a lot from 2021, but the business is still growing. So I just want to talk about it today and see if we can potentially see if it's a good investment and dig into it a little more. So what exactly is Upwork and how does it work? Well, Upwork is basically helping businesses grow and find different talent and agencies. And, there's kind of two segments to it, right? You have this Upwork basic and then you have the Upwork enterprise level. And just kind of the regular Upwork, the basic and kind of the marketplace is where a lot of that revenue is growing for Upwork. And the enterprise portion is a little bit of a smaller portion for Upwork at the moment. But basically how it works is like you're going to sign up, you write a job post, you decide that fixed price for that specific project. It's really popular with like software engineers. And you post a job and you create a company profile, right? So how Upwork is going to make money off of this is that they're going to take a portion of that. Right, so it's kind of the same thing for the enterprise Upwork, but they're going to charge you a little bit more. But obviously, the services provided are going to be a little more professional, right? Because it's for an enterprise. So yeah, you're going to have this whole hiring process where you review the talent, the proposals, you can interview them, and then you can hire them. And then, like I mentioned, Upwork will take a portion of that. So that's kind of how they make their profit from you and their sales. So just going over the last quarter, pretty good quarter actually. We had net income of 18.4 million. I think in general their net income is negative, so this is one of the more first quarters I believe where it became positive. GAAP EPS of 0.13, very impressive because EPS was negative before. Adjusted EBITDA of 33 million. They raised their revenue and EBITDA outlook for 2024, so the margins are getting better. And they have this adjusted EBITDA target of 35%, which is quite solid, right? So 19% year-over-year revenue growth, and the marketplace take rate was 17.7% in the first quarter. So that's kind of what I was talking about before with the marketplace revenue kind of taking over, not so much on the enterprise side of things. And the active clients grew 5% year over year. That's a little bit of a weaker number considering we're not even in the millions yet for accounts, but this is a smaller company, so anything is really positive. I mentioned before about the positive net income, very, very good, and free cash flow, just free cash flow was over 15 million compared to negative free cash flows before because of all their expenditures. So very solid quarter. Just taking a look at their guidance, they're expecting 190 to 195 million for the second quarter, and the diluted EPS of 0.88 to 0.92. Sorry, I'm reading the wrong number. 0.21 to 0.23, and full year guidance is around 770 to 80 million, which is up from before. And shares outstanding are going to go up a little bit, and I'll talk about stock-based compensation in a little bit. But we're going to have a big EPS improvement compared to the past. So just talking about their balance sheet, very clean balance sheet. Cash right here. So you can see they have about $500 million of cash that they have available. They have another 200 million in escrow. So very solid balance sheet considering the fact that the current liabilities are 289 million. So nothing to worry about over there. They do have total liabilities of 651 million, but their total assets are greater, which is nice to see. Like I was talking about before, their shares outstanding are going up a little bit, and I'll talk about that a little more. They're diluting shareholders about 5 to 10% this year, as expected. Just talking about their historical revenue, right? We can see that during kind of that 2021 and lagging a little bit to 22 when everyone was working from home. A lot of people were hiring contractors. Everyone's working remotely. And now, like, not as many people want to come to the office, but most businesses, especially large companies, they're having people come back, and everything's kind of getting more to a more normal. A lot of people are working hybrid at the least now, so things are going back to normal. But we saw in 2020, 2021, 2022, this type of service was just exploding in active users, and like you can see their revenue growth, 25%, 34%. 23%, so extremely impressive numbers. When things kind of got back to normal in 2023, they grew, but it wasn't as rapid as before, and that's kind of expected, right? Just because everyone's going back to the office. Most people are going back to the office. And this year, they're poised to grow about, I think, 9 to 10% as well. So they're still growing, just not as fast as COVID. Looking at their gross margins, we can see it's really nice because their gross margins have steadily climbed, and we're at 75%, and they're guiding for keeping their margins really high, so that's very good for the business. Okay, in terms of their shares outstanding, like I talked about before, we ended last year with 137 million shares outstanding, and I think in their outlook they said this year we're going to have around 142 to 145 million shares outstanding. So we're talking about a 5% dilution to shareholders, and that's pretty good. I mean, if you consider the fact that before they were raising capital like crazy, but now that they're more profitable, they don't have to dilute us as shareholders anymore, if you were one. So that's good that they're not going to dilute you so much. But you also do have to remember that they are giving out, I believe, 20 million in stock-based compensation every single quarter. So we're talking 80 million in stock-based compensation, and we're probably going to have similar to that number of free cash flow this year, given the fact that we had around 15 million this quarter. So at least for now, their whole free cash flow is going to be stock-based compensation, basically. But I mean, they just recently started getting profitable, so I don't want to say it's okay, but it's kind of typical. Looking at the GAAP EPS, we can see that in 2026 they're estimated going to have 0.65. If you look at today's price, which is a little over $10, that's a pretty low ratio, right? Like that's like 15 times 26 earnings. But you got to consider the fact too that a lot of people are going back to work. It's not clear if they can keep up, growth. I mean, 10% is slower than what they usually did, and it's not clear if it's not going to keep slowing down. So we're talking 15 times earnings. Even if they improve their free cash flow by double digits, it's over, I'm sure by 26 over half their free cash flow is going to still be in stock-based compensation. It's 15 times forward earnings with all that stock-based compensation, and you're not necessarily guaranteed kind of that 10% growth, although the analysts do say that it's going to grow 10% for the next 2 years. To me that's not bad, but it's not super attractive to me right now at $10 a share, and the main reason is I'm not sure this business model can keep growing so much. Obviously freelancing is a big thing, but with everyone starting to go back to work, my gut feeling is this service is going to slowly be starting to use a little bit less. It still might grow, but maybe just in the single digits. And also, it's not clear that they've also found a way to that they can increase their margins even more than this. And even though their margins are pretty good right now, they're only making like 15 million in free cash flow from all that revenue. So I think they'd really need to increase their revenue to make more of that free cash flow, because right now none of it is really going to shareholders. It's mainly just stock-based compensation. So even though it's come down like 80% at $10 a share, 0.65 EPS, that's like 16 times earnings, or actually that's probably a little more, 16, 17 times earnings, with all that stock-based compensation, maybe growing 8 to 10% at the best, in my mind. I think it's not a bad buy here, but it's nothing great. I would, something like PayPal would be a lot better than this if you're talking company with high single digit growth, and free cash flow numbers just much better. But yeah, I mean, if you bought it here, I'd understand, especially if you kind of understand the consulting and freelancing business a lot more. You might think there's potential. So I don't think Upwork is a buy just yet. I think if it dipped like another 15%, it'll be really interesting valuation wise, especially if they keep continuing growing at like 10%. I think that would be really, really interesting, and I'd potentially, after I learn more about the business, get in. But I think at $10 for now, it's still kind of a hold. It's not that cheap. It's not expensive, but it's not cheap either necessarily. So yeah, interesting business. I'm just watching it for now, seeing what happens.